You're listening to the Big Cast, your source for the latest in financial technology. Brought to you weekly by the Best Innovation Group, with your hosts, John Best and Glenn Sarvati.
Welcome to another edition of the Big Cast. My name is Glenn Sarvati on behalf of the Best Innovation Group, where we like to do cool things with financial technology. And we've got a pair of interviews for you today from a couple of companies that are doing some really interesting new stuff with new product offerings. We're going to be speaking to Austin Wentzlaff from Nook and also Danielle Sesko from TrueStage about their new product, Payment Guard. That'll be coming up in just a second. Want to remind you, you can always find out more about the Best Innovation Group by visiting our website, big-fintech.com. I'm also going to suggest that maybe you check out our CU Town Hall. If you weren't there, we just did a really interesting and well-attended one in the past week about the situation with ransomware that you're probably aware has been really kind of firing up more broadly around the American business overall, but very specifically around some situations in the financial services industry. We had an expert, our old friend Roger Grimes was on talking, gave me a bunch of really interesting nuggets that I came away with. You can listen to a replay of that episode by going to cutownhall.com. I'll post a link in our show notes, but if you go out to that website, it should be the most recent one listed, if depending on when you're listening to this. CU Town Hall episode 119. I would definitely encourage you to check that out because I think it's some very relevant information that I think pretty much anybody can use, whether you're applying it to your credit union or to your personal situation around defending against ransomware. And if you're interested, the next CU Town Hall will be held in just a couple of weeks. Wednesday, July 24th, 3 p.m. Eastern Time, noon Pacific. I do not know what the topic of that one is, and the way the world has been evolving so rapidly these days with new stuff going on, almost on a daily basis, I'm not sure that the topic that we would have today will wind up being the one in effect when we run that, because we always try to talk about what's the hot new things that need to be discussed from the standpoint of how credit unions can do the best to support their members. So cutownhall.com, once again, free to attend those sessions, but you do need to register in advance, and we'll get you set up with a link. One of the things, and a link that we will share, again, in our show notes, and I've mentioned show notes a couple times. If you're listening to this at our website, big-fintech.com, you should see the show notes directly in front of you. If you are listening through Apple Podcasts or Spotify, you should also be able to click through to those as well. We always try to include the links to help you kind of track down some more information about the things that we're talking about. Roger Grimes, during that CU Town Hall, shared a piece from the Register about the Evolve Bank and Trust data breach. And this is an interesting one that kind of is a matter of peeling back the onion, and something that I wanted to talk about more broadly as well. Evolve Bank and Trust recently announced a data breach that they say is likely to have affected 7.6 million users. And notice I use the phrase users as opposed to account holders because it gets pretty sticky from there. Evolve Bank and Trust is based in West Memphis, Arkansas. And they are about given everything going on there right now, I'm not sure exactly how their asset size is changing. Last number I saw was they were about a $1.3 billion bank. If you do the math on that, that implies that you've only got about $140 on average per account. That doesn't make a lot of sense, and there's a reason for that, because Evolve has been involved in the banking as a service space and has done a lot of work with folks like, I won't get into the names. I'll let you kind of follow up on that yourself. I don't want to implicate people, but it's kind of gone awry. And here's where I thought things got really interesting, is the way that the tenor of the media coverage of this has started to change. I heard a story about Evolve in the top of the hour headlines on NPR last week. And it's the first time I've ever heard them mention open banking specifically, without any reference to exactly what it was. And I'm not sure the general mass market has a real sense for that. But they talked about the fact that it affected 7.6 million users, and that it also affected not just their account holders, but open banking users. I really wonder what the average listener made out of that. But it seems to be a little bit of a direction of where things are going. I'm also going to tie this together to the situation with Synapse, which you may be aware of. They worked with Evolve, and that's where things really get messy. I've also posted a link to a story that the New York Times did recently about Synapse. The whole Synapse story, I'm going to give a tip of the hat to Jason Mikula, who puts out FinTech Business Weekly. You can track him down on Substack. He has been like a dog with a bone on this one, and he's really tracked down a lot of great granular details. So if you want to go down a rabbit hole, he's a great one to kind of find out what's really happening in that space. The bottom line is Synapse is, again, a middleware provider that actually is kind of empowering banking as a service. Then you've got all the different providers that actually are, providing these accounts on top of that. The question is, where is the money and who's insuring it? As people know, probably the question of who has third-party oversight authority, particularly in the credit union space, has always been interesting. I'm very happy that these are banks and not credit unions we're talking about, because it's gotten very sticky. But the problem that we've run into now is there's a whole bunch of people who had accounts that ran through Evolve and Synapse who didn't even necessarily know those names, probably didn't know those names, and their accounts are now frozen. So the New York Times article is saying FDIC insurance, why is it not covering this? Well, the bottom line is the money wasn't lost from a bank. Evolve is saying, we didn't have the money. Nobody ever gave it to us. Synapse doesn't seem to have the accounting that shows how the money actually flowed through. Everyone's pointing fingers at everybody else. And you get back into that really awkward question of the whole notion of the security aspect and the comfort and confidence and trust, keyword trust, that comes out of the whole notion of FDIC insurance really kind of gets unraveled a bit on this. And I hate the fact that the FDIC is being blamed for this. The only thing I could say is, if they didn't have the authority to be going outside banks themselves, maybe they could have, kind of been monitoring better who was using their logo under false pretenses, because many of these companies pointed out, your money is FDIC insured. Well, sure, it's insured if it gets to the bank, but now what we're finding is it didn't seem to get to the bank. It's a mess. Let's just leave it at that. As I said, Jason Mikula, FinTech Business Weekly's got some great stuff on it on Substack. Great New York Times article. I've got links to that, as well as to the breach at Evolve Bank and Trust, which seems to be a little bit of a side story on this one. It doesn't directly tie in, but it certainly doesn't make things any better. But what I'm wondering is the market, the mass media, is finally waking up to this notion of banking as a service, and whether they call it that by name or not, and open banking and what it means for the protection of people's accounts for the first time. And I'm kind of curious where that goes. We tend to always just play the blame game. There's definitely something that needs to be done here, and something that needs to be watched. Something tells me it's going to take a negative turn before it takes a constructive one, but we'll see. Back to our main attraction here. I've seen Austin Wenzlaff on the circuit a couple times recently. I know we spoke at GAC earlier this year, and then again at NACUSO, where Nook was presenting or displaying at both places. And interestingly, at NACUSO, this was before they had formally turned Nook into a CUSO. And they've flown that banner quite proudly. They've actually got it very clearly at the top of their website. Nook is now a CUSO. They're also doing some really cool stuff with personalization, but the idea of how focused they are on the CUSO model was what really caught my attention. But we wound up, I caught up with Austin, and we talked both about what they're doing in terms of personalization and also why they see the CUSO model as so critical to their success. So let's have a listen to my conversation with Austin Wenzlaff. I'm here with Austin Wenzlaff, the co-founder and CEO of Nook, which I guess I can say is one of the new CUSOs, one of the new CUSO kids on the block. Is that fair, Austin? You guys are a newly minted CUSO, right?
Yeah, I think that's fair. I know at the NACUSO event back in whatever month that was, April, I believe, we were the newest CUSO. I don't know if anybody else has taken the crown yet, but we were freshly minted right before that event took place, which was very good timing for us.
Yeah, I noticed, and you're quite proud of it. We'll get back to this in a second, but it says right on the front of your webpage, Nook is now a CUSO. So, and I know that was part of your plan all along, but why don't we just start first with a description of exactly what the Nook mission and value proposition kind of lays out as?
Yeah, definitely. So Nook's mission, our short mission statement is, we are bringing relationships based banking back to credit unions. And what we mean by that is we think that credit unions had an incredibly strong core differentiator in the past, which was we knew our members inside and out. And that's because we were built very specifically for a core group of members. And, because of that, we had this trust and we had this relationship, and, they did a lot of business with the credit union as a result of that. We're saying that, that needs to come back into the fold because we've actually started to lose a little bit of our grip on that, because credit unions have gotten a lot bigger. It's just kind of a natural consequence of growth as we've expanded our field of memberships, as we've expanded, into digital channels, and as we've expanded, across, geographical footprints. It's been very difficult to say, hey, we are an institution that's specifically focused around you and your life goals. So our whole mission is to bring that back. And the way we're doing that is through what we call niche experiences. So in other words, can we go after a core group of people and focus on them deeply like a credit union did, 50 years ago? But we don't have to invent a new credit union from scratch or do anything like that. We can simply do that within the parent brand, and I always like to say, let's not throw the baby out with the bathwater. Many of these credit unions already have very well established, trusted brands. But within that, we can take extra specialization and personalization to really dig deeper with core groups so that they feel, again, like, we are really hyper focused on them, and they're going to build a relationship with us and then hopefully do more business with us as well.
So I mean, obviously there lies the name Nook, which you're kind of getting into very targeted areas of the member base you can actually appeal to. And my understanding is part of the other value proposition is we're not talking about major core integration and major efforts on the part of the credit union to roll this out, right?
Yeah, exactly. So I've been in this industry for just over a decade now. I think I crossed that 10-year mark earlier this year, actually. And one of the things that I've encountered in the last decade is I've always been on the fintech side, partnering with credit unions. And one of the biggest hurdles that we always encounter is, well, I don't have the resources to implement this, and I don't have the the tech resources to focus on that core integration or LOS integration or whatever it might be. So when we built Nook, we were very intentional about, okay, how do we help credit unions as much as we possibly can, but do so without the need of tech integration and also without the need of a lot of ongoing support and resources from the credit union, and really truly be an extension of their team, not another project to add on top of the list that I know they don't have bandwidth for. So yeah, we were able to build this in a way where we can actually implement and go live, just like we did with our clients, like Dort is an example. We can go live in a matter of 2 weeks, zero tech integration, almost no resources required on their end to get rolling. And then after we go live, same thing, basically no resources required from them. Meet once a month essentially, and then we kind of run the show in between those meetings.
Now, I know Dort is actually the reason that you're a CUSO too, right? They, one of those, liked it so well, they bought into the company. They are your one CUSO investor now, correct? In terms of credit unions?
Yeah, that's correct. And it's one of my favorite stories to share because I've known Brian, the CEO there, for a handful of years. We met in different capacities when I was working for, I think, Renify at the time. And I've had a good relationship ever since. And he was one of the first people I called up when we first launched Nook and said, hey, I have this crazy idea. Here's what we're thinking we're going to do. But we need someone to help us pilot out our solution, because right now it's just an idea. We haven't actually proven it. We haven't built it. We haven't done any of that stuff yet. So would you be crazy enough to jump on this this journey with us? And he said, sure. So we were able to pilot it out and start to see immediate success with them right after we went live. And that's when him and I started to have the conversation of like, hey, I think this thing actually has some legs. We're onto something. Would you be interested in coming on as an investor and an owner and in the company and kicking us off and becoming a CUSO? And that's ultimately what happened. So, I have a quote that I share with everybody, which, is from Brian, that says the main reason we were attracted to Nook and investing in Nook was because it actually worked, and that's what we were hoping to see within that pilot period.
Now, you mentioned though that you always had the intention of, I mean, assuming that you proved out the concept, which is pretty core to the process, and you did that. You always intended to be a QSO. So can you say, I mean, again, as you said, you've got about 10 years of experience in this space. What is it about the QSO model that kind of was the reason that you made that part of your general kind of business plan?
Yeah, it's funny. We kind of had the cart before the horse on the whole QSO thing. We actually incorporated, and the name Nook is taken by, I think, Barnes and Noble still from their
Oh,
device.
that's right. I forgot about that.
Yeah, so we had to come up with a different incorporation name, and we just added QSO into it. So we are incorporated as Nook QSO Inc. Far before actually getting that investment from Dort. And we did that when we incorporated because we knew, like, hey, it's going to happen. It's a matter of when, not if, that we become a QSO. And the reason for that is we are building this solution very intentionally for a use case and a problem that I think this industry needs to solve. And I also know from my last 10 years in this industry that there's a significant amount of opportunity in this industry that we can focus very specifically on credit unions and build a very large, sustainable business. And that's what we're doing. So I like to tell people we're not tourists, we're not just experimenting in the credit union space to see if there's a revenue opportunity. We've been here for a decade. My whole founder, co-founder group has all been here for at least a decade, each. And we know this industry very well, and we know that we want to, stick here and kind of, innovate and bring, new solutions forward specifically for the credit union use case.
Now, specifically, again, obviously you've got to focus on one particular go-to-market strategy, and you mentioned you're targeting individual kind of subsegments. But the 50 and over is the one that you've gone to market first with Dort. And I think before when we were having the conversation, it's the big base of operations and the kind of the low-hanging fruit to really maximize. That's the approach you've taken in going to market?
Yeah, exactly. I mean, there's a lot of different, call it niche opportunities within individual credit unions that might be even more, hyper focused and specialized than what we're doing today. But one of the things that we decided to do when we built Nook was there's got to be a bunch of common niche strategies that can be shared across the entire industry and kind of leverage the collaborative nature that exists already within the credit union industry. So what are those common larger groups and larger strategies that we can go after? And we're building out, those so that they can be repeatable and scalable across the industry versus doing like a custom, one-off for an individual credit union because they're, focused on the sheet metal workers in this county. Like that's too specific for us right now, at least anyway. So yeah, we started with the 50 plus age demographic, and the reason we started there was for kind of two key reasons. One is it's the lowest hanging fruit. It's what, credit unions already have a lot of those members. And I know a lot of them are talking about, well, that's a bad thing. They're aging out. We actually, don't think that's true. Not yet anyway. We think there's a lot of opportunity to capture. And that kind
That's
of
also where the money is, right?
Yeah, that kind of goes to my point too, which is the consumer spending in that group is substantially higher than other demographics right now, and all of the data supports that is going to continue for the next 2 decades. The 50 plus group will continue to outpace millennials and Gen Z in their consumer spending as they're entering retirement, going into retirement, and kind of going through that phase of life. And a lot of the theories too that I hear in the industry is that, well, those people don't need loans anymore because they're at that stage in their life where they have cash and they're more just depositors. But that's not true either. They're buying boats, they're buying RVs, they're buying vacation properties. They're doing a lot of very large financial purchases where they would prefer to use a financing mechanism versus using their cash or their retirement savings. So there's definitely still a lot of loan activity that can be captured in that group, and there's definitely a lot of deposit and wealth management opportunities there as well. So we think it's the best group overall, but we don't think that's the end all be all for our strategy either. It's just our starting point. We do plan to venture into other niche opportunities. Those could be younger demographics if we want to stick to an age specific strategy, but we're also looking at kind of product or event type of strategies. So like an example of that would be small business owners.
Yeah.
I think that's a really good group to go after, somebody that credit unions kind of struggle to communicate with, because they're, small business owners are focused on having a partner, not having a transaction, house. So that's one of our strategies. If we're really, going to build relationships and bring relationship, based banking back, I think small business ownership is a really good place for us to be. Home ownership could be another example. There's a lot of different, large categories that we can bucket people into that we want to focus and build a unique experience around.
That makes sense. And and to your point also, you can't, if you want to be scalable, you're not going to create a standalone solution for every individual implementation. And I'm thinking that the way that you're modeling this, I know Dort is what, about $2 or $3 billion credit union, but it sounds like if you take this approach and you don't have a heavy implementation lift, you can take this down to some relatively small size credit unions too, right?
Yeah, definitely. We are, because of, and that was actually another really strategic reason for not having the tech integration, and that, we had to put some thought into how do you do this without any tech integration, but that was very important to do it because of that reason too. My previous company, as and Paul's was on approach, data warehousing, data analytics for credit unions. Every credit union we encountered had a different system, a different core, a different LOS, and that would hinder our ability to work with them, or at least it would have to put things on pause, because we'd have to go construct this entire integration, and that was especially true on the smaller credit unions. They were on these unique core systems that were really designed for small credit unions, and the opportunity size was really not that large for you to want to go through an R&D exercise to build out a large integration. So with Nook, we don't have to worry about that. I can work
literally with it makes no difference what core you're on. You absolutely agnostic. You don't have to wait until the first one is implemented, so you've got the template. Doesn't matter.
Doesn't matter at all. Yeah, we have no direct integrations. So the core system doesn't matter. Data formats don't matter. None of that stuff matters. So we can literally work with a $2 billion shop on Scimitar, and we can work with $100 million credit union on ShareTech, if that one still exists. I don't know. Yeah, you can find us through our website. We have a contact us form on the contact page, so that's probably the best way to do it. Otherwise, my email is austin@nook-inc.com. You can also find me on LinkedIn. I'm pretty sure I'm the only Austin Wentzloff on the planet. So it's pretty easy. Just search Austin Wentzloff and you'll find me. But yeah, other than that, I think, those are probably the best ways to get a hold of us. And we would love to have those conversations. Yeah. And like I said, there's kind of an endless opportunity for us in terms of which credit unions we can work with. So if you're a large credit union, come talk to us. If you're a small credit union, come talk to us. We're not holding off against any one group. That's something I've seen with some other fintechs where it's like, hey, we just want the 3 billion and up or 4 billion and up credit unions, and that's not our strategy. We're trying to help this industry, as much as we possibly can across the board.
Great. Austin Wentzloff, co-founder and CEO of Nook. Appreciate the insight. Got to be a lot of fun at this stage of the ground level, getting this thing going, but look forward to following along.
Perfect. Thanks, Glenn. I appreciate it.
Sure, we'll be hearing a lot more, so we'll be keeping track and following up with Austin in the near future. Another product that I've been watching very closely is Payment Guard, which is an offering from TruStage Financial. Actually, I first ran into Danielle Sesko in Madison, Wisconsin, at their home base, and thought I might do an interview with her at that time. And by the time we actually found a place, there was a noisy train on a really gorgeous spring day that kept going by. We're like, let's just talk about this stuff and save the conversation for later, which is what we did. Payment Guard offers a new twist on loan insurance for the borrowers. There's been lending insurance out there for some time in the marketplace. This is different because it's actually provided by the lender without an opt-in necessary and at no cost to the borrower. Presumably what that means is the lender sees a benefit of doing this and can come out ahead for a variety of reasons. And as they've gotten a little more traction, and they've been in the market now for about a year, I thought it was a great time to catch up and understand this a little bit better. They were also just recently at Finovate, which kind of got them back on my radar too. So again, conversation. Let's hear what Danielle has to say about Payment Guard. I'm here with Danielle Sesko, the Director of Product Innovation and Management for TruStage, which I'm pretty sure most of our audience is familiar with TruStage. Danielle and I spoke a while back, and more recently, TruStage Payment Guard was on stage at Finovate out in San Francisco, which I think is a great opportunity to kind of get caught up on the new product offering. Well, not entirely new. You've been in market for about a year now. Am I right, Danielle?
Yep, we launched in January 2023.
Great. And one of the things I noticed is the mention was loan insurance products, as was mentioned. It wasn't you, but somebody else from Payment Guard on the demo. That the insurance products for loans really haven't innovated that much since the 1950s, but obviously the lending process, particularly online, has innovated quite a bit. Can you say a little bit about how you've kind of approached that?
Yeah, first off, thank you for having me, Glenn. I'm excited to be here. And that's exactly true. Lending insurance is not new to the economy. It's been around for several decades now and has taken various forms throughout the years. And for the most part, it hasn't changed and evolved. The same products that we had 30, 40 years ago are the same products that are still in place in the marketplace today. However, lending has changed. The nature of lending has changed. Consumers have voted with their keyboards and their mobile devices that they want to take out a loan online. And financial institutions, credit unions, and fintechs, as well as banks, have stepped up to the plate to provide those solutions. So that experience is so much different than the experience that existed back in the 1950s. Because what happened then was we've had the internet, and a lot of our lives have turned mobile and digital into e-commerce solutions, but lending insurance has not changed much. So that was really the underlying driver for us to create a new digitally native lending insurance product for digital lenders, one that is easily integrated into their experience, doesn't add friction for the consumer so that there's no distraction when they are going through the process of taking out a digital loan, and they get insurance as a component loan itself. And one of the things that we've heard, actually, I would say two things we've heard from lenders as we were designing that product is the first being they are looking for differentiation. As loans go online, they become commodities, so they're looking to stand out. And the second thing we've heard was they're looking for ways to reduce defaults, to build more resilient portfolios. So those are the underlying drivers behind our design.
And I'm sorry if I can just kind of clarify, because one of the other things that's different too, I believe, and maybe this isn't totally brand new, but this is not an opt-in. This is not the borrower is not like opting in or paying for this. This is actually something that's offered across the board as a benefit and is funded by the lender and basically baked into the general offer, correct?
Yes, that's correct. It is a lender paid solution. And by making a lender paid solution, every borrower within that portfolio, loan portfolio for the lender is covered. So it is truly portfolio protection, which helps to build a more resilient portfolio for the lender, helps protect them against unexpected charge-offs, defaults, and it's a win for the borrower because it helps protect them, their cash flow, in case of unexpected job loss or disability.
So what kind? It sounds like you kind of run the gamut in terms of the type of loans you will cover in the digital channel. I mean, I know, just to give people perspective, I know QCash is one of your clients. We've talked to QCash here before. So those are relatively small dollar loans for people who need to kind of bridge a tight cash crunch. But my understanding, you're also working mortgage, auto, pretty much anything originated online?
Yep, that's exactly right. Our vision is that insurance lending coverage should be ubiquitous across all loan types, and that spans the gamut of small dollar cash advances, such as QCash's model, buy now, pay later, personal loans, auto loans, and including mortgages. We want to, because the consumer need in all of those scenarios, regardless of the loan that they're taking out, is the same. They need a financial backstop in case of unexpected loss of income.
That makes sense. So from a modeling standpoint, I mean, I understand that you've got, like I say, lots of coverage options. Or do you allow your individual companies that you're working with to decide, this is the size of loan, this is the term of the loan? What's the customizability of it?
As we think about this is a commercial product, so it's as you mentioned, a lender paid solution. We want to make sure that it's configured in the way that it meets the lender's needs. So the lender's needs for a mortgage lender is going to look vastly different, perhaps, than the needs for a cash advance lender. So we do allow for purposeful configuration of the product so that it's structured in a way where we're ensuring that we're at the overall hitting a positive ROI for each lender that we're working with. And that ROI is calculated of our insurance premiums relative to the reduction in marketing budget for acquisition costs, as well as the reduction in defaults and charge-offs. So we do allow for some purposeful customizations for each of our lenders to make sure that we're, at the end of the day, meeting their business needs.
Yeah, I saw you recently put out a white paper along with Cornerstone Advisors and kind of talking about flipping the script where this becomes a lender paid benefit. And I guess, and again, there's no cost to the borrower is the model. Now let's talk about that a little bit. I think what that implies is that the business model says, okay, lender, you're going to pay for this, and you're actually going to come out ahead in terms of reduced charge-offs.
Exactly. Premium less the amount of charge-offs, less the reduction in efficiency in marketing spend results in positive net income for all the lenders that we're working with.
And we should also be clear, I don't think we've said this yet. This specifically is insurance against job loss or disability, correct? That's the coverage. It's limited to that degree of, those are the reasons why people are not paying.
Yeah, absolutely. And we started with those and we've landed on those two coverage types because through our research, we found that those are the two leading insurable coverage types that cause defaults to occur is unexpected job loss and disability. Those are the leading causes of losses of income that are insurable risk. So that's what drove a large part of the product design as well.
And I know that was the point of the demo you did at Finovate is just how easy it is to file a claim, which is also an online process to actually, and I think I heard some number, roughly half of the claims are pretty much adjudicated on the day of submission.
Yep. I was ironically just looking at that stat this morning. It's about 43% are adjudicated within the same day.
Wow. Now you mentioned the differentiation on this. How are your clients actually, and your client again being the lender, how are they promoting it? I mean, to differentiate, the borrower has to see that this is something that they're getting in addition to a typical kind of vanilla loan. How are they going about making them aware of that?
I will say that online lenders are very savvy marketers from our experience, where they know how to reach their target consumer, where they want to be reached in their journey with the message that they want to receive. So we have several of our lenders who are using social media marketing, paid search advertising, on-site messaging as well. So we're seeing a variety of different techniques and tactics used within a broader marketing strategy. And those lenders are D2C lenders, direct-to-consumer type of businesses. So they have really substantial and robust online marketing plans.
It's probably worth pointing out that TruStage obviously has a variety. I'm talking about the bigger TruStage has a variety of loan insurance products. Payment Guard is specifically set up for the digital marketplace and working primarily with indirect lenders, right? So I mean, we've mentioned QCash. I believe I saw Zirchu and Happy Money, which are both KISOs that I'm familiar with from other walks of life. Is that is the market that you're actually looking to address with this product?
Yep, that's exactly right. Our goal is to work with the brands and lenders that consumers trust and use. We have products for credit unions in their direct lending space, and we have now products such as Payment Guard for indirect lending and fintech lenders and consumer finance companies.
So 1 year in, how's it going? What's next? Is it kind of where's the roadmap head from here?
Well, we're pretty excited with the progress that we've made so far. We're covering well over 400 million in protected loan balances. The Cornerstone paper that you referenced highlights some of the validated success we've had in market of achieving the things we said we want to do, reduce defaults. That is our goal, and reduce acquisition costs, produce a positive ROI for the lender. So where we're going next is we're continuing to expand. We're adding new lenders every single month, and we're excited about where the future is so that we can protect more consumer loans and as well as the businesses that consumers are choosing to do business with.
Yeah, I hate to even bring this up, but the unemployment rate, inching upward. I think natural cycle that happens. I assume that benefit winds up becoming even more attractive, just in terms of covering the bases of individual borrowers as they're looking at these things. Are you seeing any along those lines? Are you seeing any evidence of that kind of a change yet in your data?
We're priced long-term for economic cycles, but one thing I will say is that we are seeing a higher rate of consumers who are concerned about being laid off or have layoff anxiety. And I think there's recently a study that's done by Bain that show that over 50% of consumers had some level of life anxiety over the last 12 months. So to me, that just further punctuates the need for this type of product in the marketplace and the value that a lender can bring to their borrowers who do have this product.
Yeah, I saw another study recently that consumers, I think the supply demand curve is finally shifting to the point where it sounds like workers are a little bit more willing to make some concessions, whether it's overtime, work, weekend work, or even relocation to hold on to a job, which I think points to that same kind of anxiety that you're talking about. So if people want to find out more, we'll post the link to the Finovate video, which I think is very instructive, the white paper. Anything else? The TrueStage website, the best place to find out information?
Exactly. The TrueStage website is the best place to find out more about Payment Card.
Great. Well, Danielle Sesko, Director of Product Innovation and Management, not just for the Payment Card product, but for all of TrueStage Advisors. Thanks for taking the time to talk to us.
Thank you for having me, Glenn.
I've included a couple of links on that one as well. We've got the Finovate demo, which focuses primarily on the claims process once somebody does need to make a claim against this insurance, which is why the conversation we just had focused more on the business proposition in the first place. And then also the Cornerstone research paper, which was sponsored by Payment Card about the whole notion of embedded lending insurance. So you can, again, check those out via the show notes at Apple Podcast and Spotify, or right there on the website at big-fintech.com. That's another episode of the Big Cast in the books. Again, my name is Glenn Sarvati. You can track me down via my firm, 154 Advisors. You can find me on X at 154 Advisors. You can certainly find me as well on LinkedIn. You can find the Best Innovation Group on LinkedIn at, or X, at Big Fintech. Our Grand Poobah John Best at JB Fintech. You can always find out more, as I said earlier, through our website, big-fintech.com, including all kinds of interesting services around generative AI, voice recognition, etc., etc. You can check out the next credit union town hall, the CU town hall that takes place. I'm not even going to say if it's bi-weekly or monthly anymore. It kind of goes back and forth. But we are having one on July 24th, I can tell you that. And you can find out more about that at cutownhall.com. We post new content here on the Big Cast every Tuesday, and you'll find something new. And well, depending on when you're listening to this, whether it's a Tuesday or not, check in the next Tuesday, and you're going to hear something. We've got all kinds of great stuff lined up that runs through the rest of the summer, and it won't be long before we start pre-gaming for the fall conference season. Until then, again, my name is Glenn Sarvati, and as always, thanks so much for listening.
Check back each week for the latest from the Big Cast. Or better yet, we hope you'll consider subscribing for free via Spotify, Stitcher, Apple, or wherever you get your podcasts. If you have questions or comments, we'd love to hear from you. Tweet us at Big Fintech, email info@big-fintech.com, or visit us at big-fintech.com and click on the Media tab, where you can post a comment or check out our archive of hundreds of past episodes. See you next week.